Namaste, welcome to this video in our series Finance and Investing Tidbits. I'm going to talk about a concept that you as an equity investor must be aware of, and the concept is of leverage. I'm going to talk about operating, financial, and total leverage. Now, this is something very important. So, I'm actually going to create three videos, this one, and then there are two more to talk about a practical use of this concept. I'm also going to talk about what went wrong with Kingfisher Airlines, right? And at the heart of the problem was this leverage again. So that's something I'm going to explain in the next video, and in the video following that, I'm going to talk about how we could actually practically use this concept in our own investing. So welcome to this video. Friends, I'm sure you're familiar with this statement called as statement of profit and loss. Statement of profit and loss depicts the organization's profit performance. It essentially compares its income and expenses. So I'm not going to get into those details. I'm sure you're very familiar with it. And a typical statement of profit and loss will have the top line, which is the core income, income from sales, sale of goods, services, operations, so core income, and then non-core income, which is kind of incidental income that the company earns, that gives you the total income. And from that, when you reduce cash operating expenses, now again, I'm not elaborating this whole thing. I already have separate videos and I'll provide you links to those. But very briefly, cash operating expenses are those which are typically paid for as a part of the running or operations of a business. So they would include employee costs, they would include rents, they will include energy cost, raw materials, travel and conveyance, various expenses which are required, which are not necessarily paid for when those resources are used, but sooner or later they are required to be paid for. Now, the word cash operating expenses distinguishes them from the concept of depreciation. And of course, we're going to talk about that briefly. So from the total income, when you reduce cash operating expenses, you get the concept of EBITDA, which again I have discussed separately in separate videos. From this EBITDA, when you reduce depreciation, now depreciation is also an operating expense, but depreciation does not involve an ongoing payment to anyone, and therefore it is called as a non-cash operating expense. Whereas the examples that we have seen earlier, the employee costs, rent, travel and conveyance, energy, all require a payout on an ongoing basis. So from EBITDA, when we reduce depreciation, we get EBIT. And of course, from EBIT, when we reduce interest, we get profit before tax. And then of course, when we reduce tax, we get profit after tax, or the bottom line of a business. But for now, I am ending with profit before tax because I just want to show you how this very statement can be reorganized in a way which gives us some very different and very interesting insights. Particularly, we're going to discuss about the operating and financial leverages in this video. So I will restrict to the insight in respect of this aspect. There are a few other insights which are also available when you reorganize this data using certain principles, which I'm going to talk about very soon. So there are other data points which become available, like the break-even point, the margin of safety, but I'm not getting into those details in this video. I have separate videos on those subjects. For now, let me focus on the concept of leverages. So this is what I was saying, that from profit before tax, you reduce taxes, you get profit after tax. Now, what we're going to do is we are going to focus on classification of costs based on the concept of how does it behave in response to change in production or sales. Again, I'm not getting into details of fixed and variable costs. I have separate videos, the links to which I'll provide in the description box anyway, for those who are not yet initiated in this idea of fixed, variable and semi-variable costs. But very briefly, fixed costs are those which arise out of capacity creation. Whenever an organization creates capacity, whether it is talent, whether it is manufacturing capacity, whether it is office space, whether it is any other kind of infrastructure, fixed costs arise because they are contractually paid for by time. Like salary is paid for by time, rent is paid for by time, and so many expenses are paid for by time. And they're typically called as fixed costs. On the other hand, you have another set of costs which are called as variable costs, which are not linked with time, but they are rather linked with volume or throughput or sales or consumption or production. So essentially, they have a more quantitative relationship with the throughput or usage. Now, what we can see here is that the cash operating expenses pool can be classified into fixed and variable costs. So what I'm going to do is, for those of you who are interested, I will also provide a downloadable Excel file to this video so that by looking at those different sheets, you can experience how those costs can be classified into the buckets that I'm talking about right now, and how that data can be used for calculating operating and financial leverages and many other data points like break-even point, margin of safety. So do download that Excel file for your reference. Right now, I'm not bringing in the conversation with reference to that Excel file specifically, but you can use that Excel file more as an illustration of what I'm going to talk about here. So feel free to download that and study it. And again, if you like, you can revisit this video and see that Excel file in that context. So the important point here is that these cash operating expenses, some are fixed and some are variable in nature. The depreciation as an expense is fixed in nature because depreciation is recognized based on time. We have already discussed this, that fixed costs are those which are arising out of capacity creation and are typically expressed with reference to time. And then, of course, you have interest costs, which can again have both fixed and variable elements. For example, when you borrow for long-term infrastructure, you create a loan which is going to be repaid over a long period of time. The amount of interest is well defined. That is fixed in nature. But when you borrow based on the specific surge in business because of seasonal variations or during festive seasons, you need to borrow more. That interest is going to be variable because there is going to be a linkage with your sales or production activity. So what we find here is that the traditional statement of profit and loss, which is what is published by the companies as a part of their quarterly results as well as a part of their annual report, we can reorganize that data using this fixed costs and variable cost principle. So we will discuss how new insights can be obtained by such a classification. So now, without getting into the top two lines of core income and non-core income, let me begin with total income. And similarly, I'm dropping reference to taxes and profit after tax because it's only in this middle portion we're going to reorganize this data. So the breakup of total income into core and non-core can continue. Similarly, after profit before tax, we can continue to show tax and then profit after tax. That's perfectly fine, but I am concentrating on the middle area where we are going to reorganize the data using variable and fixed cost discussion that we just had. Of course, as I told you, those of you who are not very familiar with these ideas, do look at the videos that I'm also going to share in the description box, plus download the Excel file and then you can experience that yourself. Now, what we're going to do is we're going to divide these cash operating expenses into operating variable costs and operating fixed costs. Again, as I said, look at the Excel file for more details. And then depreciation is typically an operating fixed cost because it is linked with time. And interest costs can be divided into two elements: financial variable cost and financial fixed cost. Remember, here we are using these words operating very explicitly and financial also, because when we are going to organize this data on the right hand side, we are going to focus on both the variable and fixed nature of costs, as well as we're going to distinguish between operating and financial nature of the cost. So with that, what we can do is we can do something very interesting. So total income is here the starting point, the profit before tax here is the ending point. What we are reorganizing is the middle portion. So what you can see here is that the total variable cost is partly coming from operating variable cost and partly coming from financial variable costs. Just to refresh your memory, operating costs include employee costs, energy, raw materials, packing materials, spares and consumables, travel and conveyance, administrative costs, and so on. Financial variable costs is that part of borrowing which varies with the seasonal cycle of the business or the ups and downs which happen in terms of sales and production activity. So these two variable costs together, we are going to report under the variable cost line. So total income minus total variable cost give us a concept of contribution. Again, I have created separate videos on this concept of contribution and applications of that concept of contribution. So do explore those videos as well. Now we have two layers of operating fixed costs. One which involves an ongoing payment, which we call as cash operating expenses, and second one which is depreciation, which does not involve an ongoing payment because we've already made the payment when we acquired that equipment or plant and machinery. So two layers of operating fixed costs make one layer here, operating fixed costs together, and contribution minus operating fixed costs gives us a slightly different definition of profit which we have not observed on the left hand side, and that can be called as profit before financial fixed costs. Now we already have this one bucket left called as financial fixed costs. So let's bring that here. So we have dealt with all those three boxes of costs and we have brought them under three new boxes of costs on the right hand side. As you can see, the starting point and the ending point remain exactly the same, total income and profit before tax on both sides, but the data has got reorganized. Now this provides us some very interesting insight, and that's something we're going to see in the context of operating and financial leverage. So what is operating leverage and what is financial leverage? Operating leverage can be defined, as we can see those two arrows, as contribution, which is in the numerator, divided by profit before financial fixed costs in the denominator. For example, if the contribution is say 100 rupees and profit before financial fixed costs is 30 rupees, then the operating leverage will become 100 divided by 30, which becomes 3.33. The difference between 100 and 30 is nothing else but the operating fixed costs of 70. So 100 minus 70 became 30. 100 divided by 30 gave us the operating leverage of 3.33. Now financial leverage is profit before financial fixed costs, which in our example was 30. If you reduce financial fixed costs of say 10, we get profit before tax of 20. So 30 divided by 20. 30 divided by 20, profit before financial fixed costs divided by profit before tax, 30 divided by 20 gives us financial leverage of 1.5. So total leverage is nothing else but multiplication of operating leverage into financial leverage. So 3.33, which is the operating leverage multiplied by 1.5, can be calculated as the total leverage, which comes closer to 5. Alternatively, we can directly look at, as you can see, when we multiply these two leverages, the denominator of profit before financial fixed costs, which was used in operating leverage, gets cancelled with the numerator of profit before financial fixed costs, which was used in the financial leverage. So when we multiply the two, what happens is that these two, denominator and numerator, get cancelled, and what is left is contribution divided by profit before tax. So you could use total leverage as operating leverage multiplied by financial leverage, or you could simply divide contribution by profit before tax. In this example, it was, if you remember, 100 and then profit before tax was 20. So 100 divided by 20 straight away gives you the total leverage of 5. Remember this, that high operating fixed costs results in high operating leverage. I'll repeat, high operating fixed costs result in high operating leverage. Some industries, like airlines for example, have high operating leverage because fixed costs are dominant in their business. So as we all know, during COVID times, airlines were quick to suffer because their business came under cloud, but they had a lot of fixed costs because they had to pay employees, they had to do certain basic maintenance of their aircrafts, irrespective of whether the aircrafts were in flight or not. So all that gives rise to a very high level of fixed cost base, high operating fixed cost base, and that results in high operating leverage. So for now, just keep that in mind. Similarly, companies which tend to have high borrowings would have high financial leverage. Again, let me repeat, companies which tend to have high borrowings would have high financial leverage. Right now, I don't want to burden you with the implications of this leverage. I'm going to cover that in the next video by taking example of what went wrong with Kingfisher Airlines. So therefore, I'm going to release 3 videos, this one and 2 following, one on Kingfisher and the one in terms of what care as investors we should take once we understand the concept of operating and financial leverage. So those videos are going to follow, but do watch them too so that you are able to fully understand the implications of leverage. For more such videos, do explore our channel, Dr. Abhijit Fadnis. Thank you.